friends, let's continue with our lecture on the banking. So here in this lecture we will try to understand the income statement. Okay, so here if you look the income statement of a bank, it will look little bit different for a income statement. It look different from the income statement of a non-banking firm. For example, Reliance is having a very different type of income statement because they are basically making some stuff, making some goods and selling that. Okay, there you will find the net sales. Out of net sale you will subtract the expenditure, then you will get the PAT and other things. But here we will use a little bit different terminology altogether. For example, when we talk about the first thing, how much revenue they have earned, rather than saying it a revenue, although sometimes we use the word revenue as well, but we use generally it is what used is interest income. How much income they have earned, how much interest income they have earned, that is how much income through the interest they have earned. And other income is how much non-interest income they have earned. For example, they are making some brokerage services they are charging. For example, from you they charge, means if you have the account into a bank, they charge some account fees or some ATM fees type of thing, that is other income. Okay, now this the sum of these two is your total income of the firm. Okay, so total income of the bank. Now within the expenditure also we having the one is the interest expense, that is expense which is incurred toward making the interest payment to the depositors, that is your interest expense. A bank also borrow from other bank also borrow from RBI, so whatever the interest bank has to pay, that is your interest expense. Apart from interest expenses there are other expenses as well, that is your operating expenses like salaries of the people, that is other expenses which is not having the nature of interest. Now total provisions and contingency, that we look, provisions we will look at later, but all the taxes, depreciation, all has been come under this thing. So provisions are basically provision for the tax, provision for the depreciation, also there is a provision for the bad loans. Okay, that all has been included into this thing. Then provision for the bad loan again I will cover into the one of the different video. So this is the total expenditure of the for the bank. Okay, so now this whatever the number will come, that is the net profit for the bank. Okay, the net profit for the bank. So for the non-banking firm we are having something like total revenue. Out of total revenue we will remove the various COGS type of things we are used to having, then we have the gross profit, then depreciation, all of these things we are having, then we calculate the profit after tax. But rather than calling it profit after tax, we are calling it net profit, just a net profit. Okay, now having understood this is not a very difficult thing, let's do the analysis of this statement. But prior to that, this is the thing which I already explained, that interest income is income generated on the loan, and in investment this income is nothing but that interest which you are getting on, that bank is getting on the loan or investment. For the interest expenses, interest paid on the interest bearing liability. Net interest income is interest income minus interest expenses. Only it's only the interest income minus interest expenses, net interest income. Okay, so what it is tells you, this again a number which is telling you how efficient is management to raise the fund and how efficient it is to deploy that fund. Okay, so if management is very efficient in raising the fund, then they are going to have a very less interest expenses. If management is very good in deployment of a fund, then their interest income will be more. Okay, so that's why net interest income is basically tells about the bank management's overall capability in controlling the interest rate or controlling the interest rate, means basically towards the expense side as well as towards the income side as well. Okay, so now this is another non-interest income, or sometimes it's also called other income, which is not having the interest in nature, like fees based activity, account fees, commission, all are those are other income. For the non-interest expenses or other expenses are like salaries, building rent, all those are the interest non-interest expenses or other expenses. The difference between the two is called the burden. Now it's an important term, that is it's non-interest expenses minus income. You will rarely find some parameter is defined as the expense minus income. Generally it is defined other way around, income minus expenses, but this is a parameter which is defined as non-interest expenses minus non-interest income, and name is implying that it's a burden for the bank. Okay, so burden is generally positive for the bank because major revenue is towards the interest income only. That's why it's generally I think and I have not seen any bank who is having the negative budget, negative burden. It's generally it's always I have seen a positive burden for a bank, although size of burden is decreasing with the time, but still it's a positive for most of the bank. Why it is decreasing, that we will look at. Now provision for loan, it's nothing but a loan which is being created for bad loans. Okay, in case some loan becomes a bad, then the provisions will going to absorb this. Again this I am repeating, I will explain it little bit detail in a later session. Now net income can be said that it's the net interest income minus burden minus provision for loan or simple provision for provisions minus tax. Okay, so this is a net income. Okay, so just an mathematical thing which has been done. Your net interest income is interest income minus interest expenses. Okay, net income is your interest income minus interest expenses, and your burden is if I talk about burden, it's a minus sign. So burden is nothing but your other expenses, and minus minus will become a positive plus other income. Okay, because burden expenses minus income. So if you take care of this minus sign, then it will become minus other income plus other expenses minus provisions minus tax. Okay, so this is nothing but this interest income plus other income is nothing but gives you the total income, and all our others are that interest expenses, other expenses, provisions for loan, tax are expenses. So it's nothing but another way to write the net income is net in term of net interest income and burden. Now let's proceed further. This is the thing which changing scenario which we are observing the banking industry is basically with competition, pressure on the bank net interest income is decreasing. Okay, so pressure is increasing on the net interest income and margin is decreasing because now more and more competition is coming into the picture, and if you want to take a loan and you are having the more options, so bank has to decrease their pricing, and similarly bank to attract the more and more deposit, bank too has to increase their deposits interest rate. So that's why net interest income is increasing. If you look at the trend over the last few years, basically after opening up the banking industry for the private players, so this is decreasing with time, but yeah, still it is no, I'm not saying that net interest income is is becoming a fall very drastically. It is decreasing with time, and in fact it's a trendy thing that sometimes decreasing, increasing, but overall trend is towards the negative side. Okay, so that's why that banks are basically now focus is banks is towards the decreasing their burden or making it negative. Now for the banking analysis performance, the few ratios which we will do, which we have done for the non-banking companies as well. One is the return on assets. The return on asset is basically how much return bank is getting on the asset, simply net income over total asset, and this you should remember, and you should compare it with non-banking fund which is having the PBIT over total asset. Okay, so here for example net income is nothing but PAT, profit after tax type of thing. So when you are talking about banks ROA, so banks ROA will take the PAT into the picture, net income into the picture. Net income is nothing but same as PAT. Whereas for non-banking firm, we will take the PBIT into the picture. Okay, into the account. Okay, so this is your one difference between the analysis of a bank and a non-banking firm. Okay, so why we are taking the PAT not PBIT here? So you can guess yourself why, because here the asset is majority of asset is nothing but the cost associated with the asset is nothing but their interest only. Okay, so that's why that interest has to be excluded from the net income from the bank to understand, to take the effect of the actual effect of the or actual return which those assets are getting. Okay, so that's why you will not remove the interest from here, but for non-banking firm the interest expenses occurring not because of the assets as such. Assets, for example, you have bought a machine by taking some loan. Okay, so although I would say that interest has been come into the picture because of you have taken the loan, but if you talk about the efficiency of the machine, in that case that should not matter whether you have financed it for the loan or from some other activity. That's why interest expenses is not taken into the account when you are calculating the ROA for the non-banking firm. Next is ROE is same as which we have done for the non-banking firm. It's a net income over total equity is ROE for the bank. Okay, so it's sometimes you can say that PAT over total equity is ROE for the bank. Now after that, let's take an example, and to get the idea into our mind, let's do the examples here. So it's a capital and liability. It's a simple balance sheet of a bank. One side you are having the capital and liability of the bank, other side you are having the assets. Okay, so this is the number which has been shown here. Now if you need to calculate the another thing is interest income. This is the simplest balance sheet of a bank, that is 460 the interest income, and your 40 is the other incomes. Interest expenses is 300, other expenses including provisions and everything is 100 rupees, and you are getting the provision is 50. Now provision entry I have put differently, it's a 50, and you are getting profit of 50 rupees. Okay, so this is what has been this number is representing. Okay, so now if you need to calculate the net interest income, that would be only this interest expenses interest income and minus this interest expenses, that is 460 minus 300, 160 is net interest income. If you talk about the burden would be nothing but this other expenses 100 minus other income which is 40, that is 60 would be your burden. If you talk about the ROA is nothing but net profit which is 50 upon total asset which is 1200, that 50 or 1200 is the ROA. If you talk about ROE, that would be 50, that is a total profit, net profit upon total shareholder fund which is 100 here. Okay, capital and surplus is 100 here, so this would be your ROE. Okay, so now this is about the various parameters. Now we'll look at and we further work on the ROA and ROE, but that we will do into the next video.